Hello everyone, we have cleared some major hurdles last week as several giant US companies have reported their earnings. Amongst them, quite a few of the major tech companies gave us disappointing results in terms of their earnings, growth and forecasts. But yet the market held up and even rallied towards the end of last week. So is this the classic bad news is good news? Are these bad earnings already priced in? Or is it because elections are around the corner? Let's discuss more in this video. The stock market had a very volatile week with earnings-related swings and reversals throughout the entire week. But at the end of last week, major indices showed resilience and strength by rising quite significantly. Some investors might be wondering amid the sell-offs in tech companies why the market is still holding up. Well, if you had followed my last video, you would know my thesis is that midterm elections is around the corner. And I believe the Fed and politicians wouldn't want to create a gloomy stock market with new 52-week lows. I also mentioned that it may seem scary and crazy to call for a rally in a bear market, but sometimes such things do happen, and more often than not, we can find telltale signs of potential rallies in the technical charts, which I will talk about it later. But to be very honest, whether the rally is because of elections or good earnings report by the US biggest company Apple, it does not matter. What matters is the fact that the market is holding up well at the moment. As we enter the new week, can the rally continue? Possibly. Let's have a look at what's coming up next. First up, we have the FOMC meeting on 1st and 2nd November. I am of the view that the market is expecting the Fed to increase interest rate by 75 basis points, the fourth consecutive jumbo hike this year. Hence, I also believe that this has been priced into the market. To add on, the market is also betting for a smaller rate hike from December onwards. So do pay close attention to Powell's news conference on Wednesday, 2nd November for potential dovish view. In my opinion, if there is no major surprise from him, the current rally could potentially continue into the first or even second week of November. Investors should also be aware that the midterm elections are slated to take place on 8 November. And interestingly, through 5 midterm cycles when stocks were in the bear market, October represented a market bottom 80% of the time. Although this does not guarantee that it will be the case this time, it does offer some form of encouragement for investors, or at least gives us some indications that the current rally could potentially have more room to go. Lastly, technical indicators also suggest the S&P 500 can continue to build on last week's gain, which brings us to the next segment, technical analysis. Let's have a look at SPY, which represents the S&P 500. On the weekly chart, it bounced off the 200 moving average support and closed above the green upward trend line. These are two bullish moves. In addition, the MACD seems to be curling up, but have not, so do wait for confirmation. On the daily chart, another bullish signal is that SPY closed above the 50 moving average. But here comes the interesting part. It actually closed right at the 50% Fibonacci retracement level of 389. In addition, it has entered the Ichimoku cloud. So what does all this mean? It means that bulls are fighting to cross above this resistance level. This also means that personally, I will not go long or short at the moment until there is confirmation of a direction, be it up or down, so let the market find its direction. And let's say if the market wants to go up, we could face a bit of resistance at 389 first, then come back down to retest the resistance turn support 50 moving average at around 382 before going back up again. If this happens, and if SPY closes comfortably above 389, then SPY could fly towards 400. And then if we don't get rejected at 400, we could have a high probability of filling the gap between 401 to 406 before hitting a huge resistance at around 407 where the current 200 moving average sits. Well, from 389 to around 406, that's a huge upside. So if there is confirmation the uptrend is intact, investors who ride this upside could profit quite a fair bit. But of course, we have to be prepared for the worst. Let's see how do we catch the downside. Watch out for the range between 379 to 382. I would deem this area as demand zone where buyers should step in to protect this support area. However, if we break and close below this area, the next support is at 367, which is quite a fair bit of potential downside. So when that happens, I personally will not want to hold on to my long positions or options. As for the viewers out there, it all depends on your own trading or investment plan. Okay, let's take a look at Apple, which rallied really hard on good earnings reported by the company. In fact, I think it's carrying and leading the market in the current rally. Looking at the weekly chart, we are about to hit the 50 moving average resistance at 156. But in my view, the heavier resistance lies around 161 to 163 range. As for the daily chart, it's pretty similar to the weekly chart for the first resistance, which is around 155 to 156, where the Fibonacci level and 200 moving average are. And just like SPY, Apple is also currently sitting at the resistance level. Therefore, I will adopt the same approach as SPY, and that is to observe by the sidelines first and let Apple find its next direction. Don't forget, Apple just had a fierce run-up of 7.5% on last Friday. Whenever such parabolic run-up happens, it usually will have a pullback very soon. Anyway, after this area of 155 to 156, watch out for the 61.8 Fibonacci retracement level at 160, which should pose as a heavier resistance. If this breaks, wow, the potential upside is massive. Apple could run as high as 170. But on the other hand, if sellers start stepping in at the resistance of 155 to 156, the next support is around 150 to 151. From here, it is important to see whether Apple bounces off this area or not. If it does, and when the stock bounces off a huge support area, the trend is relatively bullish. If not, we could hit 144 again, and that is when I may pick up a few shares again. Okay, meanwhile, if you have learned something to this point, do help me with the like and subscribe buttons to improve the visibility of this video. I'm doing all this for free, and I hope to share my knowledge with more viewers. Thank you. Let's move over to my all-time favorite, Tesla. Last Friday, we have a hammer candlestick. This candle happens when sellers push down the price during the trading hours, but then buyers step in towards the end to bring the price back up to close it near the opening price. This is a slightly bullish candlestick, especially when it appears at near bottom of a downward trend. With that being said, more confirmation of this bullish signal is needed. One way is to see whether the next candle closes above the closing price of the current hammer, which in this case is 228.5. So let's see if Tesla can close above this price on Monday. Interestingly, we have an overhead resistance at 230. Therefore, if Tesla can close above 230 on Monday, it's double bullish signals. From here, the next target is to fill up that little gap between 234 to 235, which in my view, the probability of this happening is high. The heavier resistance should only come in around 246 to 247. When all this happens, I think put buyers who entered last week when Tesla was at low 200s would be in the red. So what can save these put buyers? I would say it's the FOMC meeting on Wednesday. If we get some surprise on that day from Jerome Powell, Tesla could slide back to low 200s again. Moving over to Microsoft, we had a big fat green candle on Friday, and if this rally continues, we can expect Microsoft to fill up that big gap between 238 to 245, and it may even push towards the 50 moving average of 248. I am expecting some sellers to step in at this area, so watch whether the support level of 240 can hold if it retraces back from the 50 moving average. If it does, then that is a bullish sign, and we could potentially break above the 50 moving average. On the downside, the support level marked by the blue line seems to be a strong one at around 223. If that breaks, we have two gaps at the bottom pending to be filled, and I myself will be sweeping up some shares quite aggressively at this area. Finally, we have Google. Google had a wild swing last week as we dropped to around 92 after it reported its poor earnings. But then we had a huge rally of 4.4% on Friday. Again, Google has been relatively predictable by trading within low 90s to 105 since mid-September. That is also why my option trades have been profiting. Anyway, as per my previous videos, 90 is a crucial support level. If that breaks, we could likely feel a big gap between 82 to 84. But if the current market momentum continues, I think it is more likely for us to feel that gap at the top between 98 to 102, before hitting resistance at 105. Alright, here are my end thoughts. The stock market has cleared the earnings hurdle last week. In fact, I thought the market weathered the storm quite well. With this, though we have a few more key events, namely FOMC meeting, rate hike and elections coming up, I am of the view that the latest rally has more room to go. That being said, my view remains the same, that any rally during this period is a relief rally, aka a bear market rally. I mean, the market could rally all they want, it can send SPY to 400, but I think we are still not ready for a massive bull run yet, which means we could still come back down again. Do also bear in mind that bear markets are known for sharp bounces, and remember I always shared that sometimes the bigger the rally, the harder the fall. One perfect example is the 2-month rally we had from June to August, and what happened thereafter. We created a new 52-week low in S&P 500 and various mega cap stocks. My view is that if you as a trader has been riding this rally and upside, don't be too greedy. Do start taking some profits off the table as and when necessary. Yes, the market can rally further, but how long more and how much more we won't know. Personally, I believe nobody gets poor for taking profits off the table. To sum this all up, I must say the outlook for the global economy remains quite dim, and it's quite dark out there despite the recent rally. But does it mean we should stay by the sidelines until the coast is clear? Not for me. I have been picking up shares quite aggressively in September and October and doing some options trading. And so far it has worked well for me, and I hope it does for you too. If you have not been dipping your toes into the market, I personally thought it's still not too late yet. Despite the recent rally, some good companies are still trading at relatively decent price. Alright, that's all for this video. Let me know if you're riding the current upward trend by typing in the comment section below. I would really love to hear them. And lastly, if you think my video value add to your research, please help to hit the like and subscribe buttons. Thank you.